What's up everyone, it's Karthik with MoneyVest. Welcome on board for our CPI Market Open live stream. Hope you all are doing great and are having a fantastic start to your day. It is well past 8 in the morning and we are about less than 30 minutes away from inflation numbers for the month of November. This is the last and final report for inflation for this year. And then we're going to wrap up the entire year as QQQ's S&P 500 have, of course, been selling off quite a bit over the last couple of days, although we are seeing a little bit of that momentum back higher pre-market. So trading up to over 88 basis points right now. Of course, we got the S&P 500 also up almost 0.5%. So that's where we are. Yesterday, of course, was a brutal sell-off thanks to Oracle. Thanks to AI, thanks to chip stocks, all of them selling off quite aggressively on the back of the blue owl essentially pulling out of funding for Oracle's future data centers of $10 billion. And as a result, there was a lot of weakness in that space and capital rotating out of a technology, out of AI, over to other parts of the market. So crypto right now trading back up to over $87,000 right now. We got Ethereum sitting at just over 28, almost at $2,900 once again. Volatility is sitting at just over 17. And a lot of you guys have commented in my previous videos as to why volatility is not moving. It is moving, right? So we have gone up from lows of around 14 back up to over 17. So it is up over 21% already in the last 4 to 5 days. So it's not like it's muted and it's not moving at all. It is moving, right? So 20% is still pretty noteworthy. Then of course, markets are also only down 3 to 4%. So, 3 to 4% sell off and a 20% volatility spike, that's pretty normal. If you were to get into a 10% correction on the S&P, that's when you can expect the volatility to be higher in the 20s, mid to high 20s. And that's where the buy opportunities are. So that's where the risk reward will get significantly better for us. So welcome. Good morning, everybody. Thank you so much for joining. Really appreciate you all and thanks for being here. We've got very, very important inflation numbers coming out later today. So again, in about 20 minutes or so, 25 minutes, we've got the CPI numbers scheduled to come out for the month of November. Do me a favor and share this live stream with as many people as possible. I really want to have as many traders, investors, people join us during this CPI release as it is the last one for the year. So we can also have a very engaged and valuable discussion. So definitely share this live stream on Discord, WhatsApp, share with your friends, family, so we can again have more and more people join us for this very important stream. So again, good morning, everybody. Congrats on getting debt free. Thank you so much. I posted that video earlier today. So it was a long journey of 7 to 8 years of, of course, being in debt for student loans, for, personal loans, for essentially all different kinds of debt. Obviously, I never had any mortgage or auto loans, never really had any credit card debt for month over month. Also, I always paid those off. But it's really just, wanted to pay off my student loans and be completely debt free moving forward. So very excited and very happy about that as well. Wanted to start 2026 on a very strong footing, ready to aggressively invest. That's the plan. That's the goal for next year. 2026 is all going to be about aggressive investing. That's really what I'm targeting, is just want to exponentially compound the portfolios, stocks, options, real estate, everything. Just my main focus is going to be invest as much as possible because I'm not going to have any drag. I'm not going to have any, slowdowns with regards to any debt payments or liabilities or anything like that. It's just going to be build assets, grow portfolios. That's all it's going to be. So as a student from Switzerland, it's always crazy to see how much people are paying to go to college in the US. I imagine it's been quite hard for most people to pay off. I know it is very, very challenging, right? I know education in the Europe is free, or majority of it is subsidized by the government. Of course, when you're paying taxes, you're getting very, very very good rates for what you're paying. I remember when I visited Zurich, I was talking to someone in Switzerland, and they told me that there was a big complaint, or a lot of students gathered together to protest against the university when they had raised the fees for their semester from 500 euros to 800 euros. That like 300 euro jump was enough for a lot of students to come together and start protesting against the university. And to me, that was like so bizarre. I'm like, oh my God, you can't even buy books in the US for 600 euros, let alone pay for tuition, room and board, everything, right? So yes, it is pretty crazy. It's insane how high education cost is in the US, right? So I've lived through that. I've experienced it. So I'm sure, a lot of people definitely face challenges when it comes to dealing with education in the US, especially when it's going up every year. Yes, I can check Hood. We'll take a look at Hood, HIMS, Novo Nordisk. We'll talk about all those stocks. Did Micron stop the downward momentum? We'll take a look at that as well. Good morning. Congrats on becoming debt free. I know the feeling. Thank you so much, Vamsi. I really appreciate that. I pay around 900 USD at ETH Zurich per semester. So really not comparable. That was my uni, by the way, the protest. Oh, wow. Okay. Yeah. So it might have been yours university, because when I was visiting, that's what I learned from somebody that I was talking to, that when they raised it, there was a protest. So crazy, right? There's like completely different numbers. All right. So coming back over to some stocks, and before we move further, I really just want to break down inflation first, because this is where the main focus is going to be over the next like 20 minutes or so until this report comes out. And then of course we can switch focus back to some individual stocks. We can take a look at some options. We can take a look at some individual ETFs, different charts, fundamentals, technicals, all that stuff, right? So that is going to be there. That's the plan. But right now for the next 20 minutes, the main focus is on inflation, because it's going to be coming out, last and final report for 2025. And right now we are sitting at 3% right now for inflation. For CPI, we're sitting at 3%. And the expectations are for us to increase to 3.1. So another 10 basis point worth of increase for inflation. And then if you take a look at core CPI, so all items less food and energy, it is also sitting at 3%. So if you remember last report, which was of course for September, we got both of these numbers at 3%, right? So headline CPI and core CPI, they're both sitting at 3%. And also, if you go over to the BLS website, and if you go over to the schedule, for the revised schedule, what you will notice is coming over to the consumer price index, right? So this right here, the CPI, also canceled. So we're never going to get the October numbers. So nobody knows what, or at least we don't know, the public doesn't know what October inflation looks like or what it was, because this report was indeed canceled, right? So we never got these reports. We never got this number. Similar to unemployment, there's always going to be that gap, as we discussed on Tuesday when unemployment numbers came out, that the October numbers are always going to have a gap. We're never going to know what those numbers are going to be. Same thing with CPI, same thing with inflation. This October report was canceled. And so the one that we're getting now, today, is going to be for November. So that's going to be November 2025, which is supposed to come out today, Thursday, December 18th, to essentially wrap up the year of economic data. Unemployment is going to be out of the way. CPI is going to be out of the way. Employment situation, business sentiment, consumer sentiment, inflation expectations, everything is going to be out of the way. Earnings are going to be wrapping up. And so we would be good to go to close out the entire year. So, and last but not least, I do want to point to the fact that the CPI index, if you just look at CPI index and look at Google Finance here, we can just bring it up if we can find it. Or you know what? I'm just going to look it up on Fred. Let's do this. So we'll just do Fred. Okay. All items CPI. There we go. So as you already know, when we do talk about inflation, when we do talk about CPI, it's always in reference to how much prices went up month over month or year over year, right? That's the main number that's quoted. 3.1, 3%. That's a year over year number. That's a 12-month difference for inflation. So in other words, on average basis for a basket of goods and services, where were the prices 12 months ago and where are they today? And what is that difference? That's what's being quoted. That's what's being released in terms of that number at 3% or 3.1. But what's more important for everyone to also understand is the overall inflation and what we have experienced in general, right? Overall inflation, right? How much prices have gone up since, let's say, 2020 or 2019 or 2018, and that annualized return, has that been 2%, 3%, 4% or higher? And it's been closer to 4% over the last 5 years because the basket of goods and services since, let's say, for example, 2020, it's gone from 255.8 to now sitting at over 324. So that, again, you can plot that on a spreadsheet. You can do it on an annualized basis or a total return basis and figure out how much that increase was. So just some rough expectations here, rough numbers to give you. 324 divided by 255, and we're looking at a 27% increase over the last 5 years. So that is the increase in inflation over the last 5 years, and annualized is really what we're looking for. So yeah, Kevin, thank you so much. Feeling any better? Not really. I've just been under the weather, partly because when I was sleeping last night in the new place, I had turned on the AC and I did not put it on auto. And so when I woke up, it was freaking 19 degrees Celsius. I woke up in a chiller, like I woke up in a freezer. That's what it felt like. And I immediately turned off the AC, and then I went to the living room and just slept on the couch for a little bit. So complete my mistake of not putting it on auto so that it kind of maintains that temperature and it turns off and on as it needs to. But I just completely left it on, and I woke up, like I said, with some very, very severe cold. All right, so coming back over to some stocks, we do have a little bit of time, and so we can cover some stocks here prior to the inflation numbers coming out in about 15 minutes. So again, CPI is scheduled for 8:30 a.m. Eastern, but let's talk about some stocks here, starting with, let's go over to Tesla. Now, Tesla's been trading at near all-time highs. Of course, yesterday was a big sell-off, down over 4.6%. Now it's come back down to this support. So this right here, green rectangle, as you see, very strong area of support, and resistance is going to stay put all the way up to 487 to as much as 490. That's pretty much the all-time high for Tesla. NVIDIA, Advanced Micro Devices, they've both been struggling as well. Semiconductors in general, so chip stocks, SMH, as you can see, it's been selling off aggressively, down from its highs of 377. It's down in a correction. It's down over 10% from all-time highs. So I am definitely considering picking up SMH once again, restarting with that dollar cost average next year to accumulate more shares for this ETF once again. So given how much the selling pressure has been in semiconductors, SMH also in a correction right now, with NVIDIA, of course, down over 20%, almost 20% from all-time highs, almost in a bear market as well. Support level is going to stay at a 165 for NVIDIA next. Both of my calls are up massively on NVIDIA, which is good to see because I've got the 187 and the 170 call. The 187 is, of course, way out of the money, and 170 is very close to the money right now. In fact, yesterday closed at just under 171 right now. So 19 is warm. No way. No way. You guys are, this is 19 degrees Celsius I'm talking about. So there's no way 19 degrees is warm. It's 66. What are you guys talking about? Plus, it might have been even lower because that's what it was showing me on my thermostat, but it's getting colder here too in Dubai. So I'm sure it was much lower. It might have been like 18. And that's cold. Like, that's not, it's really cold, right? Am I tripping? Is that not cold? I feel like it's cold. If you wake up and it's like, I like it around 20 and a half to 21. So anyway, how do we think the markets will react if we get a higher CPI number than expected, say 3.1 to 3.4? Dave, that's a good question. And I would say the markets will not probably like that very much because we're already seeing unemployment go up, right? So unemployment has been pushing higher. It's been creeping up. And if inflation also starts to move higher, then that puts the Fed in a very, very difficult position, right? So if you look at the dual mandate for the Fed, this right here is the bullseye chart, which we have talked about on the channel extensively, right? Before, we've talked about this many times. It's a good case study. It's a good educational piece as well. But this is really where the Federal Reserve wants to be. This is their target as part of their dual mandate, is to keep inflation at 2, unemployment at 4.1. unemployment has been pushing higher, right? So if you were to essentially put a dot on where we are now with this bullseye, we are going to be right about 4.6, 4.5. This is where we are. Inflation is closer to 3%. So this is where we are, right? This is exactly where we currently are for this dual mandate. The Federal Reserve has been targeting it to, get it down. 1 second. The Federal Reserve wants this number to get down to this level right here, right? So the main idea or the goal is for the Federal Reserve to bring this dot from here down here, which is why they are, again, lowering interest rates to make sure that unemployment starts to come down. So unemployment is going to be moving in the x-axis. Inflation is going to be moving in the y-axis. So both unemployment and inflation needs to come down in order for us to get down to this equilibrium. The worst case scenario, of course, for the Federal Reserve is that we move further into this top right quadrant, because this is the worst place the Federal Reserve can be. And honestly, this is where we have been over the last couple of years. This is not where the Federal Reserve wants to be in, right? This is the quadrant, which is the worst quadrant to be in. This is an okay quadrant where unemployment is high. And unemployment is high, but inflation is low. Inflation is below 2%. This is also an okay quadrant to be at because unemployment is really low. Inflation is still high, higher than where they want it to be. But this is the best quadrant to be in. This is the quadrant that the Federal Reserve dreams they would be in one day. But obviously, we're nowhere near close to this quadrant. We've never been in this quadrant for over 4 years now. Unemployment has been over 4%. Inflation hasn't seen below 2% in such a long time. If you come over to the actual numbers, the last time inflation was below 2% was back in 2021. So it's been over 4 years that inflation has actually seen year-over-year increase of less than 2%. So if to answer your question, long answer short, if you do see inflation come in higher than 3.1, I do believe that I think that's going to be not the best thing, not the best news for the market. I think we may see a bit of a negative reaction because also think about this. If inflation comes in higher, that's going to lower the probability of a rate cut, right? Going into next year in 2026, the market's already pricing in for 1 or 2 rate cuts. So if you look at the FedWatch tool, last time I checked, I think it was 1 rate cut. Market might have adjusted those expectations a little bit. So right now it's a rate pause for the next meeting and then 1 rate cut in March and then another one in July. So yes, the markets are still pricing in for 2 rate cuts in 2026. And inflation, if it keeps going up, 3.2, 3.3 on a year-over-year basis, I think that's going to lower the probability for the Federal Reserve to cut rates. And so going into next year, we are kind of heading into some challenges, I think some issues. Unemployment is on the rise. Inflation is elevated. The Federal Reserve has been on a cutting spree, 7 cuts over the last 16 months. So almost 200 basis points worth of cuts they've already done. And so it's going to be quite an interesting year. And yeah, over the last 3 years, markets have been very generous. And I do believe that it is skewed investor expectations as well. I think it's given us the false sense of hope that we're going to see a 20%, 30% growth every single year, which is, from experience, I can tell you is not going to be the case. It's not going to be even remotely close to being at 20% up every single year. And, we've done the analysis. I've shown you guys a spreadsheet of the S&P 500 going up over double digits 3 years in a row. It hasn't happened since 1990s. In the turn of the century, we have not seen the S&P go up 4 years in a row by double digits. It has gone up, by 7, 8%, and then up 1% or 2%. So excluding for those, I'm talking about double digits. It has not gone up 4 years in a row. So why would 2026 be any different? It could be. It could set a new record. We could see S&P up another 11, 12% next year or better. Right? But again, the odds are not in our favor. So, Okay, 8 more minutes left until CPI numbers come out, everybody. Please do me a favor, share this live stream with as many people as possible. We've got over 300 people watching. I want to get more people engaged and talking about inflation, and we'll take a look at markets reaction live in real time once we break down the CPI numbers, and then we're going to talk about some stocks. For all of you, that time is going to be dedicated to make sure that we get to everyone's questions, we get to everyone's stocks. So that's going to be the plan for today. So we got 7 more minutes until the CPI numbers, inflation numbers come in. So higher CPI is bearish and lower is bullish, right? I mean, that's how I would view it. The markets could, differ from that opinion, but that's how I would view it. If CPI comes in hotter at 3.2, 3.3, then yeah, I mean, that's going to lower the probability for a rate cut next year because inflation is on the move again. So that may not be good news for the market. 19 is cold, huh? I mean, see, again, I'm talking about when it's not outside. I'm not talking about when you're outside. For some reason, when it's like cold air coming in, and well, that's what I woke up to. It was like 19, and I wasn't even. And I know how you can compare it to like outside. 19 degrees is like nothing. It's like pretty normal. 66 is great weather. I totally get that. But I don't know. When I woke up, it was like cold air just blasting through my AC. And when I look at the thermostat, it's like 19 degrees. And I was like completely crushed with cough and cold when I woke up. It feels like the markets have already priced in a higher inflation number, but always can go down further. Don't worry, guys. They will cook the numbers and make them look less bad. So I've cash ready to buy the dip coming. Yeah, so I'm not sure if the market's already priced in those numbers. I think 3.1% may be priced in, but even with 3.1%, what are we saying? We're saying that we're accelerating back up. And inflation hasn't really, dipped below 2.8 in a long time, since March 2021. So it'll be almost 5 years of us seeing year-over-year inflation dip below 2.6. So I really don't know why the Federal Reserve is cutting so aggressively when their inflation target is just not met in over 5 years. Last time we were below 2%, like I said, was back in March 2021. So 5 years without inflation being at 2% or anywhere near close to 2%. And they're on this massive cutting spree. Like the economy is just going into a recession. But all right, so 5 more minutes left. 17 degrees for sleeping, 20 degrees during the day. All right, I'll keep that in mind and hope you're feeling better. Thank you so much. Are we starting a Money Invest Investment Challenge for 2026? Helps keep people engaged in free flow of ideas. Yes, absolutely. So we'll figure something out. I think Kevin was already coming up with some ideas. So we'll get that started for 2026, starting a brand new challenge portfolio of trading options or swing trading. I think that's going to be pretty cool, of essentially growing a small account and taking it up, with some pretty strong returns. So we can definitely work out the details for that as well. I think it'll be a good way for a lot of new people, new members, and new investors to join us, and of course follow along with how we grow an account, right? Swing trading and options trading. So yeah, iron's been nosediving a little bit. We'll take a look at that here right after the inflation report. Isn't the job market condition the answer to cutting the rates? Yes, that's been one of the reasons why they've been cutting, but it's still nowhere near close to recession levels, right? So as I've mentioned before, I've always talked about how the Federal Reserve needs to be more proactive on the way up and more reactive on the way down. But instead, what they do is they do the exact opposite. They are more reactive on the way up and they're more proactive on the way down. Like that's what they're doing. Because if you think about when inflation got out of hand, they were reactive, right? They were reacting to high levels of inflation. They weren't proactive at all. They weren't like, hey, we need to increase interest rates because inflation may not be transitory. It might stick and it might actually cause bigger problems. So let's just raise interest rates. They weren't doing that at all. They were like, oh, it's transitory. It's transitory. It's going to come down. It's going to come down. And soon they realized that that's not the case. And they started raising interest rates aggressively, which put us into a bear market in 2022. Now, what they're doing is now they're proactive. Like there's nothing really to fix at the moment. Yes, we're seeing some of the early signs of unemployment getting worse, but it's still not gotten to a point where it warrants 7 rate cuts in 14 months. And so inflation to me is always a bigger problem than unemployment, because unemployment has a quicker fix than as opposed to inflation. Inflation takes a long time. And also we have to think about the pace of interest rate moves. What's faster, interest rate hikes or interest rate cuts? What is the Federal Reserve has the ability to do much quicker, hikes or cuts? If you put that into perspective and if you think about it, the Federal Reserve has the ability to cut rates much faster, significantly faster than raise interest rates. So when they take years to raise interest rates, what do you think they should be prioritizing first? Because we know it's a long process to get inflation down. It's a much quicker process to bring unemployment down. So if it's easy and quick to bring unemployment down and much more difficult to bring inflation down, what do you think they should be prioritizing first? Get inflation down, we can fix unemployment with faster, quicker cuts later. But again, they do the opposite. That's just my view of how monetary policy should work. By no means it's the perfect view, but it's just my opinion that they should be more proactive on the way up, making sure that inflation doesn't get out of hand in the first place, and on the way down, they can be more reactive. They're like, okay, now we need to fix unemployment because it's already getting out of hand. Okay, so we've got about 30 seconds for inflation numbers to come out. So we're going to move over to the CPI numbers here. I'm going to reload the page as soon as it comes out, and we are ready to go here in about 15 seconds. So hope you all are ready for the last and final inflation print of 2025. Let's do this. Boom, 8:30 a.m. Eastern hits. We're going to open up the PDF right about now. Hopefully it's going to be for the month of November. Let's go, let's go, let's go. Come on, it's loading, it's loading. And there we go. November CPI numbers are out. 0.2% increase month over month. And inflation is sitting at what? 2.7% for all items inflation, and core sitting at 2.6. Markets were completely off by such a wide margin. We got 2.6 for core, and headline is sitting at 2.7. That's crazy. That's way off. Expectations were for 3.1 and 3, and we're sitting at 2.7 and 2.6. Of course, you can see the missing report from October. So the October and November 2025 data values are not available due to the 2025 lapse in appropriations. And so that is where we are for this numbers. You can see October, November, no reports, all items sitting at 2.7, and core is sitting at 2.6. Month over month, or at least year over year, 12 months ending, 11% increase in fuel oil. We got 3.6% increase in used cars and trucks, 3.3% increase in medical care services. But all in all, I mean, this is a insane print is what we just got for CPI. So 0.2% was the month over month numbers, and then year over year sitting at 2.7%. And of course, core sitting at 2.6, which is significantly better than where the markets were pricing those numbers to be at. Now, again, we got to really, this is a big question, right? How accurate these numbers are. How accurate are these numbers really? Nobody knows. But QQQ is pumping on this news. It's up over 1% right now. We got S&P 500 up over 63 basis points. Tesla's also moving up over 2% with that big green candle coming in. And of course, NVIDIA also is on the move, up over 1.5% as volatility coming down to now under 17. It's down almost 4% on the day. But what a print. What a report here coming in. So calculations are right there. We've got percentage change, 1 point. So 3% is where we were for gasoline, 0.2% for apparel. New vehicles sitting at 0.3% month over month from October to November. But again, you can just see so many data points that are missing from this report because we don't really have any numbers for September and October because of the missing inflation prints. So coming over to this right here, we are now sitting at 2.7 for headline inflation, and and core is sitting at 2.6. Just when I was saying that we haven't seen anything below 2.8 in such a long time, we came in with 2.7. So that's good. And then core sitting at 2.6%, which is the lowest level that we've seen since March 2021. I think everybody's going to be cheering that report. I think that's the lowest print in over 4 years, is what we just got for inflation. So that's a big deal. And I think that could increase the probability for rate cuts. Right now, the market's pricing in for 2. The Federal Reserve only penciled in for 1 rate cut for next year. But I think overall this is bullish and could create more momentum for this market to close out the year. So that's where we are. Is this a real or a made up report? This is a very real report. We just got it. And we don't have the numbers for October, of course, because September, 3% with a huge drop down to 2.6. Now, what's interesting, which again, I'm not too sure about, is when you look at the 12-month numbers. When you look at the 12-month numbers, right, this is what I'm not sure about. And I have to read more to essentially find that out. So BLS did not collect the survey data for October 2025 due to its lapse in appropriations. And BLS was unable to retroactively collect these data. BLS uses non-survey data sources instead of survey data to make the index calculations. BLS was able to retroactively acquire most of the non-survey data for October, and CPI data collection resumed on November 14th. So I mean, so what they might have done, so I think this is what they did. They used the non-survey, non-official data for October, and so basically what happens is when you have an index, right? So I'll just show you this, CPI index, we'll just go over to Fred. So right here, as you can see that this is the index value, right? It stops right here in September, 324.368, right? So this is the number where it stops. I can't go any further. October, we didn't get any reading. November, we just got a reading. But what happened was that October, since we did not get any report, and they just mentioned this in the report that they collected or using non-survey data sources instead of survey data to make the index calculations. Index meaning this is the index right here. This is the index. So they used non-official numbers for October to come up with the index value for October. And then for November, they just calculated the official data starting November 14th. So we're getting 1 month unofficial numbers and official numbers for just half a month. And then we're looking at the 12-month inflation number year over year. This is not an accurate report by any means. Like, this is not even close to what I would consider this to be accurate. None at all, because it's half a month of November and a completely unofficial numbers of October to calculate the index values and then compare it from November 2024 to then see how much the prices have gone up on a year-over-year basis. So that's what they're doing. They're looking at November 2024, which was 316,449, and then 2.7% plus 316 is where the index value is for November. So that's what they have done in this report. Which, as I said, I don't think it is at all accurate. So let's see, 324 November 2024 was 316. So if you do 2 divided by 316.449, 2.42%. Yeah. So that's what it is. For November 24, they've also increased this number right here, 315.495. Okay. So 315.495 is the official number they're comparing it off of. So this is the index value for November, which is what I was mentioning earlier. And the October number does not, there's no value for October. There's no index value for October. So that's what they did. They calculated unofficial numbers for October, half a month of November, calculated the index value 324,122. It's going to eventually show up here. There's not going to be any value for October, but November is going to show up at 324,122. And then they're comparing this number with the last November, which also seems to have gotten adjusted or revised, 315,493. And earlier it was around, let's see, November was around 316,449. So it's been revised down a little bit. So hence you get 2.7%. And then all items as food and energy, core sitting at 2.6, 330,425, and divided by 321,947. That's the year ago number, and now we're sitting at 2.6. So that is the inflation report breakdown for all of you. And markets are liking that very much, obviously, because this is huge. I think entire headlines are going to be filled with a 4-year inflation reading low, 2.7, 2.6. The Federal Reserve is doing a great job in bringing inflation down. And look, all we really care about is how the markets respond. Whether the numbers are cooked or not, I'm least bothered. As long as markets are pushing higher, which they are, great. Long term, we'll see. We'll see how it all plays out. And if there's any deals, if there's any opportunities, great. We'll be buying. But so far, so good. Everything is pumping. We're happy. And the Santa is back. Santa is indeed back. Santa rally's coming in to close out the entire year, it seems like, as Nvidia is pushing up to 174. We got QQQs up over 1.3%, gaining back some of the losses from yesterday. And S&P 500 is also on the move. How are individual stocks doing? Let's take a quick look. Palantir is up over 2.8% pre-market. Let's just come over to our Webull watch list here, and we'll look at all of these different ones. So SOXL up 10% as SMH starts to recover well. We got CoreWeave pushing higher. We got AMD, BITX is up over 5.7%. BMNR pushing up over 6%. Where's our iron, our beloved iron? Iron is, let's see, where is it? Let's just do it here. Iron is up 5.3, $35, back up to there we go, right there, 5.3%. BMNR is up, BITX is up, APLD, Nebius, we got Robinhood up almost 5%. Corby is up 4.8. Circle is up 4.4. Yeah, it's about to be a very, very green day. Look at those markets go on the back of this inflation report. Absolutely incredible amount of liquidity coming in. And likely it's fake numbers, but can't pretend I ain't happy about it. I know, right? I mean, it's pretty obvious. It's clear. They've already mentioned it in the report that we're collecting unofficial numbers, and we are only collecting official numbers for half a month. And these are the numbers that we were able to calculate. And there you go. Markets love it. Markets absolutely love it. Collection resumed on November 14th. So, perfect. Great. So, all right, let's come over to some comments here. What support do you have for Oscar? I had support at 1560, broken neck support at 13. What do you think? I'm starting to look at CSPs for around that strike. So let's come over to Oscar. I would say the next support is going to be inside this green rectangle in the 13s. So $12.50 to $13 is going to be that support for Oscar moving forward right there. let's hope, but I've seen this before. Once the market opens, the bears come out and ruin my day. Yeah, I mean, we've seen this before also, right? I mean, this could also be orchestrated by big money institutional investors to do a big rug pull, suck all the retail in pre-market, showing them some green candles, and then as soon as market opens in about 45 minutes, ruin the entire day, ruin the weekend for everyone. But I think overall, this inflation report, if you just look at it from a surface standpoint, I think it's absolutely spectacular. The numbers coming in with a huge beat. And I think Tom Lee is going to be cheering these numbers. I think most people on CNBC are going to be cheering this on with a 2.7% print versus 3.1. I mean, it's even lower than the consensus range of 2.9. And core CPI sitting at 2.6, which is significantly lower than the lower end of that consensus of 3%. So I think all in all, this was a very, very bullish report. Whether real or not, whether the numbers are manipulated, whether the calculations are correct, set aside, all those discussions aside, this was a very bullish print. And obviously we're seeing that from the market. And volatility is back in the 16s. So today might be a great day for us to start looking at some calls, right? So firing off some calls for BITX, for BMNR, for IRIN, for Oscar. Like a lot of these are just like, for me in my options portfolio, they've just been sitting there. I haven't done much because of the fact they've been selling off. And whatever calls I had, I closed them for a profit waiting for the next big green day. So today might be one of those days where we can finally fire off some of these calls once the market opens. So, hi Karthik, do you believe we could enter a long bear market like 12 or more months? Look, anything is possible, obviously, in the market. I'm always prepared for it. 12 or more months has to do with recession. I think anything over 12 months, and this is something that we have talked about on the channel, right? So if I bring up one of my spreadsheets, which is S&P 500 bear market declines. So this is a spreadsheet that we have already created. And what this is all the bear markets of the S&P 500 dating back to 1950s. These are all the bear markets, the S&P 500 when it was down over 20% from all-time highs dating back to 1950. So we're going back over 70 plus years. And what you'll notice, and your question was, can we see more than a 12-month bear market? For more than 12 months, it has to be accompanied with a recession. Because without recession, going back 75 years, the S&P 500 bear market only lasts about 6 to 7 months. On average, 7 months, median 6 months. And it's down over 20 to 23% at most, average and median numbers, and that's it. So 6 months, 7 months, we go down, 20%, 23%, and then we see that recovery. For over 12 months, it has to be accompanied with a recession. A recession is the main key story here, that if we see a recession, if we see unemployment get really bad, if economic growth starts to come down, then that number from 6 to 7 months jumps to a prolonged bear market of over 16 to 17 months. And that is over a 35 to 36% sell-off. So a bear market accompanied with a recession, 35 to 36%, 16 to 17 months on average. A bear market without a recession, 6 to 7 months only, 20 to 23% sell-off, and we're back. If you combine all these numbers together, it's 9 to 11 months. So yes, just under a year with an average median loss of 27 to 30%. And these are all the bear markets. The red ones are accompanied with a recession. The green ones are accompanied without a recession. We did not see a recession. So 2022 was the last bear market we saw that lasted 10 months. We did not see a recession in 2022. The last recession we saw was the shortest recession in history during COVID, 34% down. Only 1 month it lasted. The Fed stepped in with massive liquidity, and we saw that insane V-shaped recovery for the market. So yeah, I mean, over 12 months, it has to be accompanied, not has to, but the odds of it accompanying with a recession, and then the market's going down for 12 months in a row straight is much higher. If there's no recession, then I think I think 5 to 6 months on average, median, normal pullback, normal correction, and sell-off is very much welcomed. And we would always welcome that. Like for me, I really want to always get those opportunities. And this is exactly what we talk about, quality over quantity, right? It's always quality over quantity. So if you come over to our website and just go over to the MoneyVest index, and if I could just simply look at one index in the entire year, it would be this one. I look at this index at least 20 times a day to understand where the market positioning is, to better understand whether it's worth it to deploy capital or not. Every single year, we're going to get an opportunity. Every single year, the markets are going to give you an opportunity. The question is, are you going to be ready for it? And this year was April. It was very clear. Panic. On April 8th, that was the market low. 1.83 for the MoneyVest index. Deploy capital, buy as much as you can, and we rallied right back up to all-time highs. And since then, markets have just been on a very nice cruise to all-time highs with some occasional buying opportunities, right? So coming down to neutral, 3.4, 3.3, over here, 3.1, uncertainty, 2.8. These are all dip buying opportunities. You dollar cost average a little bit, and you let the markets do its thing. You dollar cost average a little bit, and you let the markets do its thing. But every year, we're going to get good opportunities. Very, very good, high-quality opportunities, and that's when this index is selling off below 3. And that's when I'll be ready to just buy and dollar cost average. Should these CPI data be reliable? Again, take it for what you will. We don't have any other choice but to look at these data points and for the markets to look at this data point. Unless we all collectively start surveying different stores all across America to figure out what the prices are for every single item, this is all we have. This is all we can depend on. So, we can spend a lot of time discussing whether this is reliable or not, or we can spend time focusing on how to make money off of it and where the next opportunities are. And I prefer to do the latter and not speculate on whether this is reliable or manipulated or not. My thoughts on BOJ raising interest rates. How is it going to impact the market short to midterm? I think it is going to have some impact on equities, more so on the crypto side, because I do feel the carry trade has been more overly exposed to the crypto sector since it has the tendency to be more leveraged as opposed to equities. But this time around, with the increase in interest rates, we haven't really seen much impact on equities. We've seen more so on crypto. So while that is a very big event, yes, BOJ raising interest rates after such a long time. I mean, they've had really low interest rates for as long as I can remember. And they're raising interest rates finally now to a point where that could cause some pressure for the carry trade. I think it's going to be more contained on the crypto side as opposed to equities. Equities are still going to be affected and might even be fixed income, so U.S. bonds, U.S. Treasury bonds. But there's other bigger things that we have to worry about, I would say, in the market. Okay. President Trump did brag about prices coming down, though it doesn't feel that way when you go to a grocery store. Yeah, because what you're experiencing is the overall inflation. Our brain thinks in terms of how much prices have gone up from, let's say, 3 years ago or 4 years ago. How much more am I paying? We're not thinking in terms of year over year, because that year over year increase may not be that substantial. But then when you compare it to what you were paying, let's say 5 years ago, to what it is now, that's when the difference is huge. So as mentioned earlier in the live stream, that number is closer to 25 to 30%. And that's an average number. That means there are things that are prices for items that have gone up over 50, 70, 80, as much as 100%, because it's an average, right? 30% is an average. There's items that have gone up more than 30%. There's items that have gone up less than 30%. But that year-over-year number can oftentimes be a bit more of an illusion than anything else, because it's just showing you the 12-month inflation. It's not showing you the overall inflation. And we also even did analyze this number to better figure out what inflation has been on an annual basis in the 1970s and 1980s. And that number is nowhere near close to 2%. It's much higher. And that's exactly one of the reasons why I don't think we can even bench for 2% inflation anymore. It's not for retirees, for everybody planning their future. You cannot just plan for 2% inflation. I think that would be a gross misrepresentation or miscalculation on your part to try to forecast your future based on 2% inflation, when in reality, it's closer to 3.5%. So I think it's really important to look at this data realistically, what the actual numbers are and what return we need to achieve in order for us to beat inflation and also come out ahead. Because everybody just quotes that 2% inflation like it's actually 2% when it's not. It's nowhere near close to 2%. So, okay. 3% the new norm, inflation, 100%. If they're making the CPI report seem cooler because they only used half a month, then the next CPI report, which could be 3.1% again, will make the market dive. Could be if they, but then they also might have, looked at the half a month data and then just, multiplied it to calculate the annual, to calculate the total month, right? So it's essentially what they're doing is taking a small data set, which is half a month, and then trying to forecast what the entire month might have looked like for prices. And as a result, it's still a full month report and calculation, but in reality, they only did use the half a month for the numbers, for the data, for the sources. So, so true. I forecast 3.5 to 4% inflation. My retirement planning budget better to be over prepared. 100%. I fully agree, and I think everyone can benefit from that level of foresight and being more conservative in planning their own future. Just imagine what looms below this BS-CPI report when, if the truth of this facade comes to the surface, then we better hold on for the market dive. Yeah, I think eventually, like I said, everything is gonna, stabilize. When the dust settles, we're gonna find out exactly, how the markets react. And Warren Buffett puts it really well, right? When the tide settles, you really know who's swimming naked, and that's my goal for everyone in the community, is to make sure that we don't forget our swimming trunks. We always are prepared, and we're always aware of what could go wrong. What is the worst case scenario? How do we manage risk better? We do put a lot of emphasis on risk management because I think it's really important. And that's what's going to keep us in the market forever. For as long as you want to do this, if you have a risk first approach, then you're always going to be around. You're always going to be you're going to be surviving in the market, because before you can thrive, it's more important to survive in this market before you can even think about growing capital. First thing is, capital preservation. So anyway, so a lot of questions are on iron. So iron's got a resistance at $39.40, so that is going to be that level to watch. Very strong support at $29 to $30. It kind of broke down from this bear flag, so you'll notice that we were kind of trading in this range, and then of course finally started to break down further. Next support, like I said, at $29 to $30. But today might be one of those days where I do plan on selling some covered calls on iron, even on BITX. Might be a good opportunity. It's up almost 7%. So I'm going to be looking at $40-$45 in terms of those strike calls. So today might be a good day to fire off some calls here. Are SPY and QQQ both same for market sentiment? No, they're both different ETFs catering to different stocks and different sectors. QQQ is more tech oriented. S&P is more, holistic in terms of how many company sectors does it have. And that's why we wanted to build a separate money invest index for QQQs as well, because it's been very helpful trying to also understand liquidity, capital flow. For example, QQQ is at 3.19, S&P is at 3.4. There's a pretty big difference and that divergence. And maybe we can also extrapolate some analysis from the ratio of these two numbers. So S&P divided by QQQs, what is that ratio at? If it's over 1, markets are leaning more value over growth. If it's less than 1, then markets are more leaning towards technology and growth versus S&P 500. So hope you're feeling better. I feel okay. Definitely need to get some steam. We'll put some vapor rub and hopefully we'll get better by tomorrow. Need to fix my air conditioning and temperature first. All right, so what are we looking at? What stocks you want me to go over? What are your questions regarding trading, investing, fundamental analysis, technical analysis? Let's talk. What is it that you guys want me to go over? What trade opportunities, what options trades are you guys looking into? Let's analyze them together. Just sleep, that is the best solution. Yeah, I'm really hoping for some good night's sleep tonight. All right, so Lululemon, let's take a look. We have covered this in our previous live streams quite a few times. Gapping up over 7.5% very strongly. Elliott Investment Management has acquired over $1 billion in Lululemon, boosting shares by over 6.5% pre-market, 9.5% overall. Resistance all the way next up to 228, 229. So in fact, there's going to be some resistance here at 223 as well, exactly where the price is trading. And support level at $208 for Lululemon. So pretty strong catalyst coming in. Big investment into this stock. And right now it's coming up to that resistance again. All right, Tesla we covered earlier. Adrian, so if you want to go back and check out the Tesla analysis, you will find some pretty detailed technical analysis on that. Do you think that Bitcoin cycle is finished? Hard to say. I'm no crypto expert by any means, but I just look at the technical analysis more so than anything else on crypto. And what I can tell you is that right now we're still in a downtrend. We're still trading inside this lower high and lower low pattern. And as a result, there is still no confirmation that we are ready to start moving back up. If it trades back above 94,000, I think I can be a lot more confident that there's more potential upside getting back up to six figures. But right now it's just been inside this downtrending channel, consolidating sideways, getting rejected at 94,000 right now. Okay. Tesla leaps, please. So Mihail, what I will say is, Tesla leaps now when it's sitting at an all-time high, near all-time high. Just be careful because it would have been a much better trade had it been at a support, oversold, 30% off of its all-time highs. But looking at the leaps now, call premiums are going to be very high. They're going to be very expensive right now because everyone's very bullish on Tesla right now because of the fact that it's rallied to all-time highs this week. So buying leaps here, you just run through the leap calculator and see if it makes sense. But as I said, this is usually the time for me to start selling calls, not buy them. So that would be my 2 cents on Tesla there. Netflix options trades, please. Covered calls, 300 shares, cost basis 110 for Walt. Let's take a quick look here. So 110 is the cost basis for Netflix, 300 shares we're looking at. If you go out to January 2nd, 115 is going for 5 cents, so nothing really there. You'll have to go out to at least January 30th. And we're looking at 115, around 70 cents with a 12 delta. I think this one I like. Low delta, at least collecting a little bit of premium, $280 or $210 for the 300 shares that you have for 43 days out. 115 is a strike, which still keeps you well above your cost basis. So, Friendman, for trial for the Money Vest, you can jump on a call with me and I can show you around the entire website. This is really what I've been doing is like a lot of the Zoom calls. We use that time, 30 minutes, to kind of give you an entire breakdown of the platform. And then we also have a free video on Patreon showing you everything about the Money Vest website. So that is a video that you can actually watch for free. You don't even have to be a member. And this right here, the Money Vest platform, this is a specific category just for the platform, the website itself. You can watch that for free. It's an 18-minute tutorial going over our entire platform, how to use it, all the future functionality that's going to be coming in, all the existing features, all of that is already gone over in that video. What level is QQQ Money Vest now? So 3.18, I think, is what I was just looking at. So QQQ's Money Vest Index is 3.19 is where we're at right now. QTOP and General Mills, let's take a look. So GIS General Mills, wow, very, very strong downtrend, lower highs and lower lows. We've got a pretty strong support at $45, $46. However, it is still very much in a downtrend. Lower highs, lower lows continue for this stock. So that's where we are with this. If it does break out above this resistance right here, closer to $50, then we could see some upside potential with higher highs and higher lows. But until then, I think it's going to be under some pressure. All right, so what was the other stock here? QTOP. So QTOP, a lot of consolidation sideways, it seems like, moving in this range with a very strong support. I would put down right about there in the low 30s and a resistance all the way up here at $33. So that would be a pretty good support level to watch for this, for the top 30 stocks here. And volume is low, so just be careful, with these kind of ETFs where the volume is really, really low. Just don't want you to kind of, fall into so many liquidity issues. Jeremy, congrats on being debt-free, brother. That's huge. Thank you so much. Really appreciate that. I posted a video earlier on this journey and cannot be more stress-free and relieved today. So yeah, it's been amazing. Thank you for that. Iron versus Nebius. I prefer iron, Dave. I think because of the renewable, energy and of course the defensible moat that they have. Their cost structure is very, very low. And as a result, I do prefer iron a little bit more. But, a lot of these data center companies, they do have a short to midterm cycle for how much growth is in there for these businesses, because there is right now a huge supply glut for compute. But long term, since so many companies are working towards it, they're investing so much money. If you do get to an equilibrium where demand is on par with supply, or worse, supply is outpacing demand, then there will be a repricing for a lot of these companies. And look, we've already started to see that for iron. I mean, it was trading at an insane valuation. It's already down more than 56%. It's been cut in half from its highs, and it all happens really fast. Same with BMNR. Ethereum play, it's been cut in more than half, like 60%, I think, 52, 53%. It was down way more than that. So if you remember, I've been talking about these hot stocks, to be careful in them. Every time I talk about them, every time I mention any of these, I always mention it with a risk warning, because they can be incredibly volatile, as is evident by these sell-offs. And that's why we have to make sure that we don't overexpose ourselves to these positions. They are tradable opportunities. These are great stocks for trading. Long-term investing, just only allocate so much that you can afford as a percentage of your portfolio. So Pooja, thank you so much. Congrats on being debt-free. I remember paying off my student loans. It was the best feeling. Thank you so much. And yes, it is one of the best feelings today. I do feel, more at ease, and knowing that 2026, I can allocate everything to investing. I think that's really what I wanted to prepare myself for. And when you look at it, you're still, working towards increasing your net worth, right? Even if you're paying your debt, that's liabilities going away, and now you can focus on building your assets faster. So for me, it was more like, okay, last couple months of the year, let me just nail down and pay off all of this. It's like taking a step back or two steps back for much faster runway in the future. And once you don't have any drag, and again, it was just the Dave Ramsey kind of in my head. It's like, just, write a check. Pay it all off, just in one go, and not worry about it. And that's really what it was. I just wanted to get it done with. And then now moving forward, I can just focus aggressively on stocks, on options, on real estate, on all the other opportunities for investing. So, but yeah, 2026, we will do like a private live stream before the year starts. I really want to hear about everyone's financial goals. so that we keep each other accountable for the goals that we're setting for every year. And I'm really curious and I'm really eager to hear about all of our members' goals for 2026 financially. What is it that you want to achieve this year with your trading, with your investing? What lessons did we learn this year? And how do we want to implement those next year? And how do we want to achieve our goals? Because it's really, finances and, increasing your net worth and growing your portfolio has a lot to do with discipline and emotions as well. It's not just picking the right stock. It's also being disciplined, being consistent, showing up every day, right? All of that matters. So, perfect. Debt-free, clear my mortgage loan. That's amazing. That's great. That's really what I want for everyone in our community, is to grow, be debt-free, and just continue to build assets. Bitcoin has the same cycle every year. From low point to high point, it takes 1,050 days. From high point to low point, it takes 364 days to reach bottom. So the bottom could be on October 5th, 2026. BM and R are about to switch and sell their Ethereum and buy Bitcoin with it. What do you think? I think any crypto related stock is going to be way more volatile than the crypto itself. Same with MicroStrategy. As you can see, that it's just been absolutely getting crushed from its highs of 450s. Down 64%. So, of course, there's been a massive sell-off in Bitcoin, but MSTR is down way more than what crypto is down. So, for me, BMNR is a small position. I will keep it that way. I'm not looking to add more. I'm just going to keep selling covered calls, keep generating more income, lower my cost basis, and see where Tom Lee takes us. In Tom Lee, we trust for now. We'll see what happens. So... But that's going to be it for today, you guys. I do feel a little drowsy and definitely under the weather with cold and cough. So I appreciate you guys sticking around for inflation. Very strong report coming in. QQQs are rallying higher, 1.5%. S&P is up over 85 basis points. NVIDIA, Tesla, everything moving in the right direction pre-market, as we are starting to see some nice pre-market gains. We'll see if S&P 500 flips for the month of December or not, because we're still down in the month of December. So thank you so much, you guys. I really appreciate it. Again, link's going to be down below in the comments and also pinned in the chat if you want to join and be a part of our MoneyVest community. Again, I definitely need some water and some rest right now. So thank you so much. Really appreciate you all. Happy investing, and I'll see you all in the next live stream.